Hello everyone. Welcome to this edition of Know Your 4C Fund Manager. I'm Narender Reddy, Head Investment Advisory at Motilal Oswal Private Wealth. And today we have with us Mr. Jigar Mistry, co-founder at Buoyant Capital. Jigar has been a market veteran with more than 2 decades of industry experience. And prior to Buoyant, he was the Director of Research at HSBC Bank. And he was also associated with Kotak Institutional Equities. By qualification, he's a chartered accountant and a CFA charter holder. Welcome to the show, Jigar, and a pleasure having you here.
Thank you, Narendra, for inviting me. Pleasure is entirely mine.
Thank you. And before we get started with the investment philosophy and the frameworks of Buoyant, I would like to take this opportunity to get your views on markets in general. We have had a stellar run over the last couple of months, and we almost touched 20,000 levels on Nifty, and then there has been some bit of consolidation over the last couple of weeks. And FIs have been continuous net buyers for 5 months till July, and in August till now there seems to be some change in trend. So what's your view on markets in general?
Right, I think very interesting phase and turn of events, I would say. It's that, this unique dilemma that one faces every now and again. If you look at the extremely long term, it's difficult to find an economy as good as India, as large as India, in such a good state of affairs. Right, so if you look around at somewhere around 3.5 trillion or thereabouts, you don't have a lot of economies available for a lot of investors at this juncture. Now, the two large parts that we are looking into are one, today the working age population in India is somewhere around 83 crore people. Over the next 2 decades, we will be crossing 110 crore people. Right now, a number and addition this large essentially implies that sort of the amount of work that gets created in the process is phenomenal. That's number one. Number two, one way to look at it here again could be, oh, where are the jobs? What will people do? But then today, just imagine these people are, for the lack of a better word, sort of freeloading onto the economy. Right? They're drawing from the national reservoir, and tomorrow, if they even accept menial jobs, they'll start adding to it. When 17 crore people, 20 crore people add to this, wonders happen with the country's destinies. Secondly, for a country of India's size, we are at 3.5 trillion or thereabouts, but your per capita GDP is 127th in the world, and at such a low level, you're still 62% deriving, income from services. So the manufacturing boom, which we left out in the process, what's the standard template, right? The standard template is become the manufacturing hub of the world, and then have a control over your current account, and then that allows you to get a control over your BOP. Now that cycle we missed. And in missing that cycle, we are now trying to sort of salami slice our way back into it, right? So what's the government trying to tell us? All right, you can, start manufacturing the 50,000 rupee phone, captures at least 1,000 rupee in value first. Then they go ahead and say, okay, can you make this glass here, capture a little more? Can you go and make a semiconductor plant, try and get something part there? So I think you're salami slicing your way into manufacturing. And all this, if you look at it from a long-term standpoint, makes a lot of sense. You can jargonize it by saying, your labor force production, participation, and your productivity gains both will likely improve. And that is the fundamental fabric of any economy. Now, from there, you go on to flows, and 3.5 trillion, a country with a large consumption base, absolutely nicely working sort of democracy, Thirdly, very strong judicial system. What is the next in round, right? Saudi at a 2.5 trillion is largely oil. Brazil at 2 trillion is largely commodities. So it's a difficult country which is growing as fast as it is for FIs to ignore, and equally difficult for even domestic investors to park their money in. So long term, clearly we are in the same camp as everybody else. India presents a huge opportunity, and it's something where equity exposure should be commensurately high for everybody to take advantage of things. In the shorter term, however, we are slightly split, right? And this is a very interesting turn of events, because as we see it, there are two broad, scenarios that could play out. And let's call one central bankers are God's scenario. Start with the premise there that economics is an exact science. Economies have no lag whatsoever. Central bankers are exactly aware how much to raise interest rate so that the economies don't sort of go into recession but only correct a little bit. And there enough time passes. Inflation, as you know, is a funny concept, right? So a 100 rupee item going to 120 is a 20% inflation in 1 year. 120 staying 120 the next year is 0% inflation. So with the passage of time, inflation could come off without prices actually correcting.
Yeah.
And that is the Goldilocks scenario with everybody seems to be pricing into the markets today. That eventually with the passage of time, you should come out of this smelling like roses. Of the 1280 companies with more than 500 crores in market cap today, 25% of these, right, so a little over 400, have actually gone up 50% or more. 60 companies have doubled in a matter of just the past 4 months. So things are great over the longer term, but I think we may be extending to a small extent on the other side of the pendulum. The other scenario clearly is that beyond a point, nobody knows anything, right? So nobody knows anything beyond a point scenario, where you know that economics is not an exact science. Like physics work on three laws, economics is not that science.
Yeah.
Behavior plays a very large part. And when the interest rate is raised from 0% to something like 5.5%, there are skeletons waiting in the closet, waiting to tumble out, right? For far too long, the interest rate has been kept at a very low level, and that creates excesses which blow out eventually, in times when your QT is very high, your interest rates are very high. And for a lack of any other logic, try discounting a US risk-free 5.5 forever. Right, so you start with a US risk-free at 5.5. You add a country risk premium for India, which by the way today is just 100 basis points, which is a 23-year low, the Fed fund target rate versus the repo.
Yeah.
Right, and that used to be like 800 basis points in 2013, 400 basis points in COVID. So we are at a very small number. And try building country risk premium, companies risk premium, and try putting that in your DCF models. The valuations for most companies you will get is much lower than when we are today.
Sure.
So I think we are split between those two junctures. In our opinion, there will be a time later in the year to dial the risk up. 10 years absolutely is a great time to be invested in equities, but I think people may be rushing into it, trying to discount a lot way too soon.
Sure, sure, sure. And how are you approaching markets at Buoyant?
Right, so for us, see, we have a few things going in the way that we do not follow a model portfolio.
Sure.
Right, I think that is very critical, especially for PMSs / managed accounts. Uh, Everybody, I think, in the right mind would agree that you should not be following a model portfolio. If you have say 25 stocks in your portfolio and money is hitting your account every single day, not all 25 are buys every single day, right? You may be in the process of selling out a few. There is no point in you buying the shares today only to sell a week, a month down the line. The reason why people do it is because sort of, it's a logistical nightmare. You can't run 5,000 accounts on an Excel sheet.
Sure.
With varying weights. So the practical solution is, just you copy paste the portfolios, right? And that's a sort of decent way to do it. But then there is a better way. When we started working with an IT company. We now have a full solution in place which allows us to run and create each portfolios as we go along.
Sure.
So when we were in March, we were essentially saying that we are investing sort of entire portfolio in a week or so, because we could buy businesses which made a lot of sense from a longer term standpoint. Today, when we are receiving, a lot of our shares have also doubled in the process of the last 4 months or so. And what we are now saying is that we are taking somewhere around 3 to 4 months from how things appear today.
Sure.
To fully invest.
Sure.
And also, so one part is, timing the entry into creating a portfolio. The other clear part, and internally we manage it with core and satellite, and I think as this discussion progresses, we'll talk further.
Yeah.
But I think if you break it down from a simple large, mid cap, small cap perspective, then, I'll run you through a little bit of the history here. In Jan 2022, we were roughly around 70% in large caps and cash. We had turned defensive.
Sure.
The markets were still looking for the next multi-bagger.
Sure.
We couldn't find businesses which made a lot of sense. Obviously, we weren't aware that Russia-Ukraine conflict would transpire. At that point in time, we said, let's just hold on. Makes sense. A lot of dividend yielding names made a lot of sense. With the Russia-Ukraine conflict and the ensuing sort of mayhem, the small cap exposure, even with us, stood at a minuscule level. And we started building that until March 2023, when small caps became 50% of our entire portfolio. Now, with the rally that has transpired, we are taking time to sort of clip off a lot of those positions. As we speak, we are still somewhere around 43%. Now, that 50% in fact has outperformed by huge margin. Right? So you are cutting 20% odd positions in small caps. You still have an extremely large outperformance to contend with, and that we are taking money off as we speak. If we are investing a new portfolio, much larger size is getting into large caps rather than the 40% small cap that we have today.
Very interesting. And before I kind of delve upon further, I would like to get your thoughts on what made you start off Buoyant in the first place, and who are your other co-founders, and how is your work divided amongst all three of you?
Correct. Buoyant is owned and run by three of us, Sachin, Viral and myself.
Sure.
Sachin Khivasara, Viral Berawala and myself. All three of us are chartered accountants with 20 plus years in the market. So as you gave a brief introduction before starting Buoyant Capital, I was the director of research at HSBC Bank.
Sure.
And my job was to advise all these foreign institutions, largely sovereign wealths, government of Singapore, government of Abu Dhabi, and long onlys like Capital, Fidelity, etc., on how and where to invest in India. And also I was tracking the global metals and mining sector. Viral is a chartered accountant and alumnus of IIM Ahmedabad. He was last the chief investment officer of Nippon Life Insurance. He was, covering a little over $3.5 billion into equity and debt. And Sachin is also a CA and a CWA, and was last with, Nippon Asset Management. So the genesis of Buoyant Capital was simple. That, for far too long, I think the way mutual funds were managing money, with an increase in size, there is a legitimate problem of running strategies which are anything other than buy and hold.
Sure.
Right? Buy and hold, if you look at the equity sort of history in India, we have a fairly smallish time frame. Right? Global equity investing is very rich, hundreds of years of data. In India, we have a market only for around 25, 27 years, which is effective. Now, for a vast majority of that, buy and hold as a framework worked very well. So let's say if you are an investor in the year 2000, you are facing an externality which is very different from what it is right now.
Yeah.
You're facing your economy which is fairly nascent, liberalized only 8 years ago or so. Your companies are very small themselves, and foreign capital in India at the time was hardly anything, close to $50 billion. Fast forward 20 years, as the economy grew, companies grew at an unprecedented pace.
Sure.
Right? Your IT story is very well known,
Yeah.
but look at cement, look at zinc mining, look at FMCG, retail, steel. Like JSW Steel grew from 1 million to 25 million tons. So on one hand, sort of capital was playing thick and hard. Companies were growing at a fairly decent click, and foreign capital was chasing it like there was no tomorrow. Right, so what was 15 billion grew to something like 600 billion by 2020. They ended up owning 22% of corporate India, 2.5 times the size of mutual fund.
Yeah.
Now, if you are an investor in this era, your job, I would sort of say it myself, is fairly simple. It's not easy. You have to still find durable growth. But if you identified a great company, that automatically became a great investment because of the sheer amount of capital chasing these good quality businesses. And that sort of we started in this era, but essentially our view was different, right? Whereas buy and hold as a framework has worked fairly well, increasingly the ingredients that led to buy and hold working are now inversing. So on one hand, you have companies not growing at the same speed, right? Obviously, you have attained a size, it's not possible for you to grow 20 times in the next 2 decades. Secondly, foreign capital is coming in, but not at the same speed, right? What was in fact 22% of India ownership is now a little over 18%.
Yeah.
And domestics are investing surely, but they are a very different breed of investors. Like FIs were largely doing it without feet on street. Comparatively, domestics have a lot more value conscious, is what we'd like to believe. Yeah. And third, and more importantly, earlier the only way for a company to raise equity was to come and get listed, right? So as a public market investor, we could all participate in that growth. Today, look at say a Nykaa, Paytm, PB, Zomato, Delivery, Car Dekho. Few of them are very interesting business models, but by the time they are offered to us as public market investors, PVCs have already extracted like a 10, 15, 20 billion dollar in valuation, and they are offering it to us at 3 to 5 times the value we are hoping to run away with.
Yeah.
So essentially we saw these as two distinct eras, and we want to profess what we call investing through cycles.
Sure.
We didn't really find anybody else doing that in India. Globally, there are a lot of funds which believe in it. But in India, because buy and hold has worked for so long, so well, I think that's the common belief system of a large number of investors. And the only other part was that, see, initially all of us had done and spent a lot of time doing research, doing investing, but a very less amount of time, facing distribution.
Yeah.
So initially we said, let's start off. It would be unfair of us to, come to you on the first day and say, look, we have done this. We have a completely new idea now. Make us meet your investors. So initially we, first 3 or 4 years, we put time creating a track record. Ran money for families who knew us directly in a little bit of our own kitty, and now sort of we have started working with a lot of partners like Motilal.
Very interesting. I mean, could you take us through a little more on the strategy itself,
Okay.
I mean, the core and satellite?
Yes. Right. So see, fundamentally, if you believe that everything operates in cycles, right,
Yeah.
and there is ample and more data on how cycles get created. So think about, say, companies.
Yeah.
Now today, let's say we are able to identify a company with a fairly long runway for growth, right? While the earnings can keep compounding at say 20% CAGR for 30 years on a consistent basis,
Yeah.
in our opinion, it is slightly naive to believe that share prices also compounds on a consistent fashion. Right, the market, having found such like a holy grail, gets so excited initially, and it starts dislocating your share prices vis-a-vis the earnings growth. So you could have a point in time when the previous X years, right, 2, 3, 5 years, the earnings would have grown at 20% CAGR,
Yeah.
but the stock price is compounding at say 30, 40, 50% CAGR.
Yeah.
Now that's one cycle where earnings growth has been much slower than your share price growth. But then the market realizes that you're paying too much to buy a business like this, and the stock prices flatlines. It goes down a little bit till the time earnings catch up, right?
Again.
And you'll be surprised. This earnings catch up cycle can very easily last 10 years. It can equally easily last 20 years as well,
Sure.
right? Coca-Cola, Warren Buffett bought it in 88.
Yeah.
Till 98, a great company and a great investment. But then for the next 19 years, when the earnings doubled, stock returns were essentially zero. Right? IBM from 99 to 12 years, earnings tripled, stock returns zero. Colgate in India, 15 years from 1994, earnings quadrupled, stock returns were zero. So essentially, stocks have behaved in cycles. In India, we didn't notice them before because you are in buy and hold frameworks. But now over the past 3 or 4 years, this is truly glaring us in the eye.
Yeah.
Right? And not just at stock level, look at sector levels. 14 to 19, all you could think about is only consumption.
Consumer.
Right? And the narrative that a lot of people built was that these companies are so strong that nothing bad could happen to them. Crude prices could inflate, commodity crude could inflate. But it's this moat around this business is so large that it's okay to pay 40, 50, 100 Ps. Right? And investors kept on buying until that cycle peaked in March 2020.
Yeah.
And for the past 3 or 4 years, it's been a very difficult time for the proponents of most of these people, which should not have been, have you looked at the 2000 to 2008 cycle.
Yeah.
Right? Capital goods was the flavor. The index was up 19 times. ABB was up 24. Crompton was up 45 times. But when that cycle peaked, it took 11 years for the index to come back to the same level.
Yeah.
Right, so what we are arguing is that you can see these cycles being omnipresent at stock level, sector level, even market cap.
Yeah.
Right, 20 years small cap and large cap, there's not a huge difference in CAGRs.
Yeah.
But between December 17 and March 20, the large cap fell 12%, small cap fell 50%.
50%.
Now the narrative that point in time was that, look, there are only these 20 great companies worth investing in, everything else you sort of completely ignore.
Yeah.
The exact opposite is today, right? Today, if you tell somebody that I'll invest in large caps, they'll look you as if you have lost a marble or somewhere. So essentially, these cycles are present everywhere.
Yeah.
The way we approach through this is that on the paper, our framework is fairly simple. We either approach the markets being aggressive, at which point the idea is to generate a superior return. When satellite, what we call satellite, is a smaller part compared, what we call satellite is a larger part, compared to the core.
Sure.
And having generated superior return, we want to protect the capital. When satellite becomes a smaller part of what we do, core becomes a larger part, and the idea at that point is to protect capital, right? So
Sure.
between say 2016 and end of 2017, we were aggressive. Then we turned defensive, could reasonably protect capital around 2018 when a lot of small cap funds fell through the cracks. 2019 we became aggressive, slightly ahead of time, I might add myself. We became aggressive in February. The market turned around, I think September, when the finance minister came around and announced those corporate cuts. And then we stood aggressive through COVID, generated a reasonably strong return. And then we became defensive around 2021. And since then we have been, obviously, see, now the markets have had a life of its own. But even on the worst sort of ambers of those times, we were still able to protect capital, which is the end goal. So when you combine these for 7 years, we are roughly at around 22.6% CAGR post fees and expenses at the PMS number.
Impressive. I think that puts you way ahead of others in the league table.
Right. So again, so a little bit of rude for me to say it myself, but yes. More importantly, see, when you compare this with the risk frameworks,
Sure.
That works out reasonably well. So look at it from either rolling return standpoint or from, say, statistical risks, right? So for example, you look at the beta of our portfolio.
Sure.
Over a 1 year, we are at 0.93. You look at 3 years, we are at 1.1 times. So I don't think that's a dramatically higher risk to generate almost 2 times market return on a 1 or a 3 year basis. But more importantly, CRISIL now looks at PMSs not just from a statistical standpoint, but also from the standpoint of how concentrated your portfolio is, how illiquid your portfolio is. And we have always managed to get their best-in-class risk rating, which is a 5-star rating. So very happy that returns are reasonably decent. They are a lot more consistent, and they are a lot better on a risk-adjusted scale.
So when you are in a bullish mode or when you're optimistic, your satellite portion significantly moves up.
Yes.
And when the case is otherwise, it moves it down.
Correct.
So at the moment, what is the portfolio looking like?
So we are in the defensive stance today.
Sure.
Core and cash is a little closer to 63%.
Sure.
We are turning that ship as we speak, because I think we are very happy with the way things have played out over the past 4 months or so. And as I said, if the pendulum is swinging on the other hand, it is difficult for us to start building a very aggressive stance from 5.5 Fed fund target rate, 86 billion in QT, and you start bringing that to India equity markets at an all-time high. So it's been great. See, 10 years are going to be great, but I think it's better off if we don't go down the quality curve today rather than going up the quality curve. If at all, see, all of us while running money, there are mistakes that are inevitable.
Sure.
Right? We'll definitely make a lot of them. The whole idea of a time like this is to utilize them to correct a lot of those mistakes which you have made in the past cycle. Because when the tide turns, see, today it might look like there is a lot of liquidity sloshing through. You'll be able to sell the positions that you have. But when the liquidity dries out, such was the case in March 2023, right? Not a huge time ago, when you try selling, a minuscule quantity, but everybody was busy putting money into fixed deposits or buying insurance with the changes in the budget, you couldn't really sell a lot of equity if you wanted to. Now with the liquidity, businesses that you fully understand, are aware and they have not run up a lot, those are the ones that you would want to be invested in, rather than trying to discount a FY27 30 times multiple with like a 300% growth from here to FY27. So that's the whole philosophy. See, doing what we do, we are never the number one on any particular cycle.
Sure.
Right? In a small cap cycle, a small cap fund will definitely do better.
Yeah.
But the best run small cap fund today was down 70% between 2018 and 2020. So the whole idea of us is to be like a top quartile performance, whichever the cycle. If consumption is great, we want to be top quartile. If commodities is great, we still want to be top quartile. But when you combine these cycles, the hope is that this will propel us much higher relative to the rest of the street.
Sure. So, in the endeavor to kind of catch up with these cycles and straddle to this shortened cycles now, what has been your churn ratio in your portfolio?
Right, that stays slightly elevated vis-a-vis peers, right? So we are close to a little over 30%. I think the long only funds would be at say 15, 20% thereabouts. But there is a number we can put to this, right? So let's say you compare us with a fund that has say 100% long-term capital gains. Such a fund doesn't exist. But let's imagine, for the purpose of extreme comparison, that we are comparing ourselves with a 100% long-term capital gains fund. Let's say in our case, it tends to be 50% short-term versus 50% long-term.
Sure.
That's also another extreme, but let's look at the extent of the extremism that's there in between. At this number, let's say at 50% of the returns, you will pay 15% tax versus 10, right? So you'll pay a 5% higher tax on 50% of your return. So in our case, let's say 22.6, let's say half of that is 11.3, which will be short-term returns. And on that, you will pay 5% higher, which is 55 basis points. Everything else has, so all expenses, STT, etc. is all announced while we calculate the 22.6% CAGR. Now this 55 basis points differential is compared to a 750 basis points alpha since inception that we have generated.
Sure.
Right? So we would like to believe that because of the strategy that we follow, we are able to fully pass this on and sort of take it under the broader umbrella. And the strategy pays for itself, because if it's just buy and hold, my submission to you would be that it won't be able to generate a 750 basis points alpha.
Yeah, absolutely. One of the reasons why investors come to a PMS house is for this agility and flexibility in terms of managing the portfolio.
Okay.
And so long as the cost is justified, I mean, it's always makes sense. So tell us a little more about the science and shifting from one sector to the other.
Correct. So I think I didn't completely answer you when you last asked me the team structure, but let me take that here and then bring you how we approach to that. So team structure, see, between Sachin, Viral and myself, we are sectoral analysts, covering different sectors. And to an extent, it is our belief that one fund manager, it's very difficult for them to understand all the sectors with the gravitas it deserves.
Sure.
Right? So when I was sort of tracking the global metals and mining sector, I had a lot of board meetings with top steel companies on what they could do better. But if you asked me about, say, IT, I can tell you 4 or 5 lines, but not beyond that.
Yeah.
Right now, if you ask me to run the fund completely, for 80% of the time, I'll do a fairly decent job, right, with the help of a domestic sort of in-house analyst, external analyst. But then there are times, Narendra, when your push comes to shove, right? Your back is against the wall. You are not able to sort of decide on where to go when. You own, say, Bajaj Finance at the peak of before COVID, and then that corrected from 6,000 to 1,800. Now, if you don't know what maturity gap analysis is, what duration matching is, you held it because everybody else owned Bajaj Finance, and you decided to sell it at that juncture, that not only impacts your 2, 3, 5 year returns, it also impacts your psyche as a fund manager.
Yeah.
Right now, with that sort of framework, uh, you come around managing a fund that creates sort of cycles which you are not aware of. But if you analyze a lot of these funds, so for example, a fund that does very well with consumption,
Yeah.
they would invariably end up underperforming in a commodity cycle because you're so used to the way in which you are structured. We are sort of structured slightly differently. Sachin, Viral, and myself cover different sectors. We become the fund managers of the sectors that we track, and therefore the cyclicality of our fund is reasonably lesser vis-a-vis others. Secondly, we approach companies also very differently. So, if I at the start of this conversation told you that EPS and share prices can dislocate, then that cannot be the sole way in which you make investment decisions, right? The way we approach it is that, let's assume that we buy out this entire business. We are not in a position to ever sell it, and all we'll ever get is only free cash flows. Then, what is the market forcing us to assume? Right? If you buy, say, a top level, say, FMCG business today, the market would force you to assume that your free cash flows for the first decade has to grow at 20% CAGR, then 10% till perpetuity. And when sort of I, who has never tracked FMCG, don't really know what it means. But Viral, who has started his career with those businesses, understands that fully, has full data on how the segmental growth has happened,
Yeah.
and he'll be able to tell with a reasonably large amount of conviction that the market is asking us to assume a lot. So that's when sort of all three of us come to the table and start believing that there's nothing sort of that's there where hand to heart you can say that there's a lot of value. Typically around that time, your sort of market valuation also starts getting inverted. So essentially, the large cap stocks, which are very well tracked, start trading at a huge discount to the whisper number small cap stocks, where everybody else seems to know more than the other guy. Typically, at that point in time, you also have a lot of these behavioral frameworks, like the valuation starts moving a lot more relative. Buy X stock at 70p because the leader is at 150p, whether 70 or 150 in and of itself makes sense or not. Or the flow of capital goes into a lot more, so there is unprecedented level of IPO, secondary markets offering, and so on. And the exact opposite happens when we turn aggressive, when the businesses are offered to us at throwaway valuations, because the market is focusing on a very narrow opportunity in the particular sector. Frankly, becoming defensive is a lot more difficult than becoming aggressive, because in a market like this, right, try sort of the market is hiding away all our mistakes, and at that point in time, you have to be like very crystal clear what you want to execute, and execution is half your wins, right? If you are able to execute your thought process,
Yeah.
then that's when you are able to pick up the pieces once the market cracks down.
Sure. Sure. And today, if somebody were to give you fresh money, how long will you take to build the portfolio, and what will be the portfolio texture look like?
So right, so it's a little bit path dependent. So if the markets were to correct, or a specific sector we are interested in were to correct, then we'll go a lot faster. But from the looks of it today, will take about 3 to 4 months to get fully deployed. Incrementally, I'd say large caps will be a much larger part of what we'll be doing. As I said, small caps have run up a lot, and over 10 years, many of them will provide a huge opportunity for growth. But then we have seen time and again, Narendra, you will get those cycles. You should be able to pick it up when the things turn around the corner.
Sure. And in terms of sectoral allocation?
Financials are still, see, okay, financials track multiple cycles: credit growth cycle, credit cost cycle, NIM cycle, and valuation cycles. NIM cycle looks like we are on the negative trajectory. Right, credit growth continues to be very strong.
Yeah.
Credit cost continues to be very benign.
Yeah.
But I think there is a place here where you will be able to sort of take the NIM contraction into stride. And the other problem with banking is that if FI sell, that's the place they own the most. All right, so you'll have to you sort of position yourself accordingly. But financials is very interesting. Pharma generic space is very interesting. Consumption, a few of the names are coming around. Tech, we had very little exposure to the large cap IT. What we had was very niche sort of place, and while that has played off beautifully well, I think large cap IT may eventually come into the zone which makes them very interesting. Auto ancillaries, railway, defense, all those continues to be very attractive as we speak.
Superb. No, thank you so much for taking out time, sharing your views and the genesis, the team structure, and the entire science behind the shift between core and satellite part of the portfolio. A pleasure having you with us,
Pleasure is
Jigar.
entirely mine.
Thank you so
Thank you so
much.
much for
Thank you.